Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. Today we examine why fax machine companies are facing major risks as business shifts to cloud-based workflows. Looking for fax stocks to avoid in this video? You are not alone. Investors are asking whether fax machine companies still make sense as the workplace shifts to cloud tools, e-signatures, and AI-powered document workflows. Fax still exists in a few fields, like parts of healthcare and government. But the long-term trend points away from paper and on-prem gear, and toward software, APIs, and secure messaging. This guide shows key risk signals and research steps so you can judge the risk for yourself. This video is for education, not financial advice. Fax machine companies look risky in this video. The big picture. Traditional fax businesses rely on selling devices, parts, and maintenance. That model works when offices buy hardware and refresh it every few years. In this video, the direction looks different. Companies want software they can turn on fast, scale up or down, and secure with clear audit trails. Legacy. Hardware-first fax vendors face headwinds that grow each year. Buyers weigh the cost of machines, phone lines, supplies, and support, then compare it with a browser-based service. The second option often costs less over time and fits how teams work now. Remote work made this shift obvious, since fixed office devices became a bottleneck. Cloud-based communications keep growing, with fax features wrapped into larger platforms. Think unified communications, document workflow, and e-signature suites. Fax becomes a checkbox feature, not the star of the show. That means vendors who only sell boxes or on-prem servers lose share as budgets move to subscriptions. Security needs also push change. Paper creates risk, since it is easy to misplace and hard to track. Digital tools offer encryption, access controls, and logs. Compliance teams prefer that. IT leaders want fewer single-purpose devices to manage, not more. The takeaway is simple. If a company depends on selling standalone fax machines or old server software, the odds are against it. If a company offers cloud fax, APIs, and workflow tools tied to the broader communications stack, it has a better path. The market is shrinking, even if some hospitals still fax. Healthcare and government still use fax in some workflows. That will not flip overnight. Yet the overall market for standalone fax machines and on-prem fax servers keeps getting smaller. Hospitals invest in digital records, patient portals, and secure file exchange. Agencies adopt secure messaging and document portals. As these tools spread, fewer departments need a physical fax device. The direction is clear, even if the timeline varies by sector. Cloud fax and secure messaging take budget from legacy hardware. Companies prefer cloud subscriptions over buying and maintaining machines. IT teams like simple pricing and quick rollout. Finance teams like moving from capital expense to operating expense, since it lowers upfront cost. Cloud fax APIs plug into CRMs, EHRs, and ticketing tools. Unified communications platforms add fax as a service, which replaces lines and on-site boxes. When fax sits inside a larger suite, there is less reason to buy specialized hardware. Rules and tech shifts speed up the move away from paper. E-signature acceptance makes paper less necessary. Health data exchange frameworks favor encrypted, standards-based transfer. Compliance teams expect audit trails and clear access controls. AI-based OCR and automated routing turn documents into data. Mobile-first work styles make desktop-bound devices feel slow. Each shift chips away at the value of paper fax and on-prem servers. Red flags that say do not invest in a fax machine company. If you are reviewing a fax stock in this video, use these checks. You can verify most of them in filings, earnings calls, and product pages. They point to weakness in a shrinking category. Falling revenue with no cloud growth story. Shrinking sales signal lost share. A heavy hardware mix suggests the core business is tied to devices that wear out, not to durable software value. If cloud revenue is flat or tiny, there is no clear pivot. Be wary if growth comes only from price hikes or one-off deals. That is hard to repeat. Watch for customer concentration, too. If a few buyers drive most sales, one lost contract can hit results fast. One-time hardware sales and weak recurring revenue. One-time device sales create lumpiness. Supplies and maintenance can add some lift, but margins often stay thin. When budgets tighten, these lines get cut. Stronger companies push for subscriptions with high renewal rates and healthy gross margins. If the only recurring line is basic maintenance on old installs, the base can decay as customers switch to cloud. That is fragile. We've gone through the signs that signal danger for legacy fax hardware businesses. Stay tuned for part 2. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.